This video is about the Federal Reserve. We're going to talk about its history. Where did it come from? Why is it here? And then we'll do the technical little org charts, committee pictures, and basically learn more about this mysterious, famous, powerful economic institution. Let's go back to 1907. There was a panic, known as the Knickerbocker Panic. And J.P. Morgan, one of the most wealthy financiers in the world, bailed everybody out. Now, what do we mean by a bailout? He wrote loans, high-interest loans, got paid pretty good for it. He even bailed out the city of New York. The city of New York was going bankrupt, and he was like, all right, I'll write you a loan. But he did all this to keep the system running. It wasn't that these banks were going bad, it's just that we were in the middle of a panic when everybody was pulling their accounts out. The financial system can't function if everybody's doing runs on their banks. And so to stop a run, you essentially ensure, don't worry, everybody's deposits are just fine. So, rather than having a private, unaccountable individual save the United States economy, it's better to institutionalize and bring transparency to the process. In 1913, Congress passed the Federal Reserve Act. Creating a central bank, one of the roles is to act as a lender of last resort. That is, if a bank is otherwise solid and has decent assets, it can use those as collateral to get loans from the central bank, and thus prevent a panic from spreading. Following the American tradition of government checks and balances and diverse power, the Federal Reserve decentralized its organization. Trust me, this is worth going through. Yes, it's called internal structure. Yes, I've got an org chart right underneath me. So Congress gives power to the Board of Governors, down below in blue. The board is composed of 7 governors. These are appointed directly by Congress. So the president nominates and then the Senate confirms. This is located in D.C. That's the famous building we always show you. But there are also 12 regional banks. That's the green below, the Federal Reserve banks. And they're spread out all over the country. Now, the interesting bit is that their presidents are internally appointed. So there's kind of this semi-private component to these banks. Their job is to do research in the local economies, to work with local businesses, provide banking services to the region's banks, help the system clear checks. Every 6 weeks, a component of them get together and form the Federal Open Market Committee. They're the ones who set monetary policy. That is, set the main interest rate in the economy. Here's a recent picture of the Board of Governors. They are chaired by Jay Powell. He was appointed in 2018 and was recently renewed for his 2nd term. Each member of the board has a 14-year term. They want to keep it long and extended. However, the particular position of the chair is appointed for a 4-year term. Now, the Federal Open Market Committee meets in D.C. It is comprised of those 7 governors of the board. Again, these are the directly politically appointed people. And it also comprises of 5 of those regional bank presidents. The New York Fed always has a seat. Why? Because Wall Street is located there. New York City is the most important financial city in the world, let alone just the United States. And therefore, they should always have a vote. Now, this is an interesting bit. Remember, there were 12 regional bank presidents? However, the voting power, the actual power to set monetary policy for the macroeconomy, is going to be set by majority vote. Who has the majority? Well, 7 is bigger than 5. So the politically elected appointees have a higher voting power than everybody. Now, all 12 bank presidents show up to the meeting. Everybody has a say. It's a 2-day long meeting. They all give their reports on what they believe is happening in their local economies. But when it comes to the voting, those 7 individuals are the Federal Open Market Committee. Now, the other 4 bank presidents, they're on the committee for about a year and then rotate out. Now, that's just how everything fits together. How does it actually operate in practice? These appointees are very professional, have tremendous experience and expertise, and generally find a common consensus. It's not always unanimous. Sometimes there are a few dissenting votes of 1 or 2 or 3, but oftentimes the path forward for the macroeconomy, at least for the next 6 weeks, is fairly clear. It's also a rather bipartisan institution. Many of the boards of governors are Republicans, and many of the boards of governors are Democrats. Jay Powell, who was appointed by a Republican president, was renominated by a Democrat president. The Federal Reserve has a long history of careful, sober analysis. I think it'd be pretty useful to go over the recent history of who have been the chairs of the Federal Reserve. This is one of the most powerful individuals in the world. I think passing a college course requires knowing a few names. So we'll go back to 1987. That's when Alan Greenspan was appointed. And if you notice, he was Fed chair all the way till 2006. That's nearly 18 years. So he was appointed by a Republican president, Reagan, renominated over and over again, including the Clinton years, a very Democratic president. His tenure is characterized by the booming 90s. We had a recession in 91, the savings and loan crisis, and another recession in 2001, the dot-com bubble bursting, and yet both of these recessions were like mini recessions. The unemployment rate didn't rise that high, nor during his entire tenure did we see any runaway inflation. It's part of the Great Moderation, or the large economic boom in the 90s. Many people referred to him as the maestro. There was an aura of the mystery and genius of the man. And at least at the time of this recording, he's still around. He's still alive. Sometimes he'll show up on Bloomberg television to give his opinions on the economy. And he was old when I was a kid. Next, we've got Ben Bernanke, 2006 to 2014. What was the big thing that happened in these years? The housing crisis, the big financial crisis. Previous to this, in the 1980s, Ben Bernanke did serious research on the Great Depression and the banking system. His papers found that the extended banking crisis, bank failures after bank failures for years, had lasting and damaging effects. The stock market was not the primary cause of the prolonged Great Depression, but in his view, allowing thousands and thousands of banks to fail was the primary cause of the deepening. Why? Banks hold information. They have relationships with their clients. And when a bank fails, that information in the market is lost, and it takes years to recoup that reputation. It takes years for a business to go to a brand new bank and gain trust and gain access to cheap credit again to keep functioning and trading in the economy. And so 2008 rolls around. We have the preeminent expert on the Great Depression, on financial crisis, and then we get another financial crisis, and he is in the position to do something about it, and he did something about it. He took the command to be a lender of last resort way beyond what had been seen before, and he prevented the housing crash and financial crisis of September 2009 from turning into the decades-long dark and dreary economy that we saw in the 1930s. Well, by 2014 he got tired, and so he retired. Next we have Janet Yellen, 2014 to 2018. She was the first woman to lead the Federal Reserve. She was also a member of the Council of Economic Advisors, that is the chief economist for the White House, and most recently she is the Treasury Secretary, the same position as Alexander Hamilton of yesteryear. On another side note, her husband George Akerlof is another Nobel Prize winning economist. So, what's the Fed supposed to do? They have a dual mandate. Number one, control inflation. Keep prices stable. Number two, minimize unemployment. Or another way of phrasing that, maximize employment. And we could see that right in the legislation. This particular verbiage comes from the 1977 version of the Federal Reserve Act. The Board of Governors of the Federal Reserve System and the Federal Open Market Committee shall maintain long-run growth of the monetary and credit aggregates commensurate with the economy's long-run potential to increase production. So long-run growth, that's all great. So as to promote effectively the goals of maximum employment, notice that's the first one, stable prices and moderate long-term interest rates. So by law, this is what they have to do. However, sometimes they have to make choices. They have to make a trade-off between them. Why? Because if you raise interest rates, yes, it can lower inflation, but it might cause some unemployment. On the other hand, if you lower interest rates, that can cause inflation, but it can lower unemployment. So the question is, how does the Fed balance them? First, we need to make a note about the short-run political incentives. If you're a politician, do you want low unemployment or higher unemployment? Obviously low unemployment. But what if this means, and this isn't always the case, but sometimes causing low unemployment today will create more inflation tomorrow? Well, that'll help you get reelected. Sometimes you need a little bit of high unemployment in order to maintain stable prices in the future. Now, what's better in the macroeconomy in the long run? What's better for employment in the long run? Stable prices. However, there is a short-run incentive for a politician to boost the economy, maybe cause a little bit of inflation, but that inflation won't be felt till after they get reelected. The solution to this dilemma is an independent central bank. This independence helps it perform its duties. Independent. Without the board getting fired or replaced, or without having the short-term goals of people in the House who have to be reelected every 2 years, or 1/3 of the Senate, which is also elected every 2 years. And in fact, this is not just a theoretical argument. When we look at the data, on the horizontal axis, we have an index for central bank independence. That's what CBI stands for. And then on the vertical axis, we have the inflation rate. And we find a very clear negative correlation. More central bank economic independence leads to less inflation. Alan Greenspan made the following two observations. Number one, the evidence does support the view that presidents of the Fed banks, that's the regional Fed banks, have been more hawkish than the governors. So to remind ourselves, the presidents of the regional banks are internally appointed. They're not part of the direct political process from Congress. Hawkish in this sense means that they are more willing to raise rates and fight inflation. The opposite of that is to be a dove. More dovish central bankers are found among the governors. His second point. In my 18 and a half years as Fed chairman, that's a long time, I received a figurative truckload of requests from Congress urging an easier monetary policy. That's the trade-off we were talking about. Lower unemployment, a little bit higher inflation. I don't recall ever receiving a single request urging the Fed to tighten. So Congress does not request them to raise rates. But does the Fed need to raise rates sometimes? Yes. The most striking example of this comes in 1980. The Fed chair at the time is Paul Volcker. We've just had a decade of high inflation. At the time, it was at 14%. And so Paul Volcker, even though he was appointed by Jimmy Carter, the president of the time, decided to raise rates. He raised rates to fight inflation. Did it work? Yeah, it fought inflation. Yeah, inflation got better. But it came at a cost of an unemployment rate of 10%. If the unemployment rate is 10%, do you get reelected? Jimmy Carter was a one-term president. So why was Paul Volcker able to do this? Because he had independence from the person who gave him his job. He was appointed for a 4-year term as chair. For a 14-year term on the board, he was immune to the short-term political pressure and was able to focus on policy that helped the economy in the long run.